let's imagine for a minute that all the money you have in the world is $7,000. That's it. You got $7,000 today. And tomorrow morning, you owe a violent mafia loan shark 10 grand. Okay. Well, you do what any self-respecting person would do, and you find yourself on a college campus, and you find an economics professor, and you pull her aside, right? And you say, you explain the problem. Here's my problem. What am I going to do? And, she takes the time. She sits down with you. She figures out, she gives you a questionnaire or whatever. She puts all the stuff into the computer, and she says, look, I'm sorry, but your risk tolerance questionnaire says that you need a 60-40 portfolio. And that's just not going to give you a 43% return by tomorrow morning. There's nothing I can do.
Welcome to Money Matters with Chris Hensley, where we spotlight financial literacy issues in the Houston community and beyond. And now your host, Chris Hensley.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, a broker-dealer member FINRA SIPC. Advisory services through Cambridge Investment Research, Inc., a registered investment advisor. Cambridge and Houston First Financial Group are not affiliated. Imagine having access to the investment secrets that have built and sustained the world's greatest fortunes. Welcome to Money Matters, where today you're about to get just that. Join us as we sit down with Franklin Parker, a sage in the realm of family offices and high-stakes investing, whose strategies have illuminated the path to wealth for the ultra-rich. Once a musician, now an award-winning financial luminary and author of the 2023 Amazon #1 release, Goals-Based Portfolio Theory. Franklin is here to share the exclusive investment tactics that typically reserved for the world's wealthiest families. But here's the twist. Throughout today's episode, we'll unveil not one, but many essential strategies that have consistently propelled the fortunes of the elite family offices. And keep an ear out, because our final, most powerful strategy will be revealed in the last segment of the show. You won't want to miss this rare insight, as it could be the key to transforming your investment approach. Whether you're building your own empire, diversifying your portfolio, or just starting your journey towards financial freedom, today's conversation with Franklin Parker will equip you with the tools and techniques of the ultra wealthy. Stay with us until the end to unlock the full spectrum of the wealth building wisdom right here on Money Matters. Franklin, okay, let me take a breath here. That was a long intro. Thank you so much for joining us today.
Oh, delighted to be here, really.
Well, I'm excited to talk to you. You are you're a CFA. You're a neighbor. You're in Dallas. I'm here in Houston. I can see your guitar in the background, so you've got a musician background. As you know, I'm very interested into diving into that as well. Let's really dive right into it. Can you maybe share with our listeners your journey from a musician to an award-winning financial advisor, and how that diverse background influences your approach to wealth management?
Yeah. So I got to the end of my music degree, and I realized that this is just not the life I wanted to live. I've got friends who've gone on to work in the music business, and I've got friends who won Grammys, friends who play in orchestras. And look, you just can't put down roots. You can't really be in one place. And a guy told me once, he said, you need to think about kind of the bell curve of outcomes in whatever field you want to go into, and then think about where you fall on that bell curve, And music is a place where a very, very, very small number of musicians make a lot of money, and everyone else, can barely eat. So, I wanted to kind of eat. I wanted to put down roots. I wanted to live a different life. And so I pivoted into finance and got in the business in 2007. And I thought, this is great. Easiest job in the world. Everything goes up. No one ever complains. And then of course, it all fell apart in 2008, 9, and 10. But had no plan B, so stuck it out. And here I am. So that was my transition. But
I love it. So I want to, since you're in the industry, I'm in the industry. We have two different types of listeners for this show. We've got your normal mom and pops who are retirement focused individuals who are going to listen to it, and then we also have other financial professionals. I'm an active manager, so I'm excited. Let's get in the weeds. I'm excited to talk about that part of it. But just to satisfy my compliance department, anytime we talk about investment stuff, especially if we're going to get in the weeds here, I'm going to read this. It just says, please note the discussions on money matters are for educational purposes only. Past performance is not indicative of future results, and every investment strategy carries its own set of risks. We encourage our listeners to consider all information provided here as a learning resource and not as a specific financial advice tailored to individual circumstances. For advice that fits your personal financial situation, please consult with a professional financial advisor. Okay, if I can get that out there. So good. I think our compliance people will be happy. Let's move on.
Sure.
Let's dive right into your book. So your book, Goals-Based Portfolio Theory, you talk about some strategies there really for real people to navigate the financial world. What inspired you to focus on this particular approach?
Yeah. So as you mentioned, I came from a music background, not a finance background. So I literally missed those days in class, right? I never took a finance class in college. And so 2007, 8, 9, 10, I was just trying to figure out, where's this advice coming from? Why do we say diversify? Why do we say buy and hold forever? Why do we say don't worry, it'll come back? I remember of October of 08, diversification didn't work. Not even cash was safe, right? Gold was down 20%, bonds were down 15%, stocks were down 20%. And the FDIC had to guarantee money market funds because they were in danger of returning less than dollar for dollar. And I thought, well, but diversification doesn't work, not when it really matters, right? And I had also had clients who were, living off of their portfolios in retirement. And sure, the market came back, but their portfolios didn't because they were locking in losses the whole way down, right? So I came out of that just with this strong sense of vertigo, and it set me on this intellectual quest. And I went back and started reading all the original academic papers in finance, and I'd Google stuff during the day, and I'd try to figure things out in Excel, and eventually kind of figured out where all of this stuff was coming from. But I wasn't satisfied with it because what I was starting to realize is that there were really pretty major holes in what we would consider traditional portfolio theory and the traditional ways we manage money. And it's because all of this thinking was done for institutions. It was done with institutions in mind. And institutions have two big advantages over the rest of us. The first one is they're typically tax advantaged, right? So if I'm a pension fund and I'm an active manager, I'm not worried about how much taxes I have to pay if I sell at a gain. Whereas an individual, I do have to worry about that. And then the second thing, and this is the big one, is that institutions never die, right? So the rest of us do. There's a point at which you need, if it's not there, why did you scrimp and save all of those years? You should have just, spent it when you had the chance. So I found myself on this intellectual quest, and I had some basic questions coming out of 2008. And I found this area of research, which was pretty new at the time, called goals-based investing, right? It's now kind of a marketing buzzword and everyone's talking about it. But at the time, it was still a new area of academic research. And it was really focused on how do you solve the portfolio problem when you have a limited time horizon, right? And when you have taxes involved, and there's a few other kind of constraints that go into the portfolio problem that traditional theory doesn't account for. And I thought, okay, I found my people, right? This is what I was looking for. And so, I started publishing in the area about a decade ago. I had some of my own ideas and started pushing the ball forward in the research. And I got to a point where no one has yet written this book. And I think it's time to kind of put these ideas together into one cohesive whole. But it really is focused on real people operating in the real world, and then what are the best approaches given your scenario. And there's all of these crazy ideas that come out of it. Well, they're crazy in the context of traditional portfolio theory, but they make perfect sense when you really look at what real people are trying to do. So
I love it. I love it. So some of the things that you pointed out for listeners that are super important, you went back, and looked at the foundations, and you realized there were some holes there, some things that were missing. I always like to say, a modern portfolio theory is not wrong, but big asterisk, there's a lot of things. And if you point to
Yeah.
2008, 2009, and we look at, that 38% drawdown, it definitely opens your eyes, right? So what can we do different here? And then you mentioned, the idea of institutions, the life expectancy or time horizon for institution could be hundreds of years versus an individual. If we're looking, 0 to 100, if we're lucky, right? So,
Yeah.
so these bringing these into your book, and then you focus on goals-based portfolio management. Let's talk about that. Could you kind of dive in, explain those concepts of goals-based portfolio management and how it differs from traditional investment strategies?
Yeah, absolutely. The I won't get into the math, but the math of the problem is completely different. Okay. So the way the traditional approach is structured, there is one human input in the whole equation, and that is your risk tolerance. That's it. And I think that is, look, I grew up on a cattle ranch in Central Texas. I have a music degree, right? So I always kind of have this sense of imposter syndrome in the business, but there are moments when I'm looking at something and I guess as an outsider, I think, well, this just doesn't make any sense, you know? And this is one of those things. I mean, to me, that is like going to the doctor and you do all of this, the doctor, you fill out your paperwork at the beginning and then the doctor runs all these tests and asks you what's wrong and tries to figure it out and then finally comes up with a diagnosis. And you're sitting in the room with the doctor and the doctor says, well, I'm sorry, but I know exactly what's wrong with you and I know how to fix it and we can fix it. But the pain tolerance questionnaire you filled out at your intake means that we can't go forward with the procedure. I mean, what? That doesn't make any sense, right? That's what risk tolerance is in finance to me, right? It's like, well, we know how to fix the problem, we know what to do, but your risk tolerance says you can't really do that. I mean, it's part of the conversation, sure, but it shouldn't be the only conversation. So goals-based investing sort of moves that conversation into, you know what are you trying to do in the real world? Are you trying to retire, send your kids to college, buy a vacation home? Tell me what that is, right? And then let's go into the toolbox of investments and figure out what the best tools are to get that job done. And I don't want to give you a wrench if you need a hammer, okay? And maybe you don't know how to use a hammer. Well, I'll help you. We'll talk that through, okay? Maybe your risk tolerance isn't high enough. Well, let's talk about that. What adjustments do we need to make to your portfolio? But really understanding what it is you're trying to do and then aligning your investments with those objectives. And look, there's several inputs to that. Your time horizon is one of them. How much money do you need in the end is another one. How much money do you have today? That's another one. What's your savings pattern? What's the cash flow requirement? All of that. And see, this is what here's another example, and I use this in the book. But let's imagine for a minute that all the money you have in the world is $7,000. That's it. You got $7,000 today, and tomorrow morning you owe a violent mafia loan shark 10 grand. Okay, well, you do what any self-respecting person would do, and you find yourself on a college campus and you find an economics professor and you pull her aside, right? And you say, you explain the problem, here's my problem, what am I going to do? And she takes the time, she sits down with you, she figures out, she gives you a questionnaire or whatever, she puts all the stuff into the computer and she says, look, I'm sorry, but your risk tolerance questionnaire says that you need a 60-40 portfolio. And that's just not going to give you a 43% return by tomorrow morning. There's nothing I can do. Well, okay, that's silly. That's not what you're going to do. What are you going to do? You're going to go to the casino and you're going to take your $7,000 and you're going to gamble until you have 10 grand or zero, because no matter what, it's a hospital visit tomorrow unless you got 10 grand, right? So what's interesting is when you start to model what people are trying to accomplish in the world, you get different things that come out of it. So what this shows you is that it may be sometimes rational to pursue outcomes that have high volatility simply because they have high volatility, and it's the only way you can accomplish your goal, right? Whereas in modern portfolio theory and kind of traditional portfolio theory, that is never rational. You would never do that. And so, there's these different kind of approaches, but once you really model what people are trying to do in the real world, your solutions start to shift a little bit.
I love it. I love it. Now, you just gave us a whole bunch right there. So, just the idea, this radical idea of it's not just about your risk tolerance. You're bringing in the real things in life, the goals based, what people are trying to do. You ask the question, what are you trying to do? That's crazy, right? But
That's why
you're asking,
imagine
right?
you're not just
And so,
investing for the fun of it. What?
right, right. So I love that. I've never heard the Tony Soprano version of getting people to adjust their risk tolerance, but I love it. I might have to use that myself.
Yeah, go for it.
That was a very good way of getting people to realize that, sometimes you're going to have to adjust, and especially if you've got a shorter time horizon and you've got these big lofty goals, there's only so much math can do, right?
Of course.
So I love that. I love that. Let's pivot and shift just a little bit, because I know one of the big things for investment is taxes, right? You in the book you talk a lot about taxation and rebalancing. They're really crucial elements in your strategy. How should investors incorporate these into their portfolio management to maximize returns?
Yeah. So taxes are really annoying, right? They're annoying. Uh, we got to pay them, and they're annoying for us portfolio managers because we have to account for them, and it really makes things much more complicated. But so the thing about taxes is that it's very individualized. And this, more than anything, is the message of goals-based investing. And I think where it is taking our industry as a whole over the next 10 to 20 years. Okay. So everything in goals-based investing is very customized. It's hyper customized. So for example, if you transfer in highly appreciated Apple stock, should I sell that to buy an S&P fund when Apple is, 40% of the S&P's movement? I mean, maybe, maybe not. There's a calculation we can do to decide if that makes sense. Okay. And in the absence of taxes, it doesn't matter. We would just sell it. Who cares, right? And then you get the benefits of diversification. But is incurring that cost, which reduces my wealth today, worth the diversification? Well, again, maybe, maybe not, but there's a calculation you can do to figure that out. So that is one aspect of it. Another aspect of it is where you place your assets. So what's the most efficient tax positioning strategy given your goals, given your time horizon, given when you need those cash flows? That's another calculation that has to be done. So taxes, just like everything in goals-based investing, is hyper customized. And of course, that makes it complicated, right? That makes the need for sitting down with somebody and discussing it one-on-one and figuring it out one-on-one that much more important, because there is no one-size-fits-all idea, right? Unfortunately.
I love it. I love it. That's a good way to talk about taxes. I also have to say I am not a CPA, so I always have to put that asterisk,
I'm
consult
not
a
either.
CPA
Yeah.
for
I'm a country
specific
boy.
tax advice. But the stuff that you just mentioned is a great way to approach taxes, because you talked about hyper customization and the idea of whether people have long-term or capital gains embedded in their portfolio. We don't really know until we sit down and do a calculation. So having somebody do that on a one-to-one basis is really a really good way to do it. And then you talked about asset location. Where do you put your assets in the front end so that you can benefit from being in a tax efficient place? These are really, really good ideas for people and things that we should pay attention to. Again, the book is Goals-Based Portfolio Theory. I'm going to keep going here. You've discussed the significant, non-financial risk in wealth management. Can you highlight a few and suggest how individuals can mitigate them?
Yeah, and this was something that, coming out of the family office world, I spent more time on than I did when I was in retail wealth management, or than I am now as well, because extremely wealthy families. And so I don't know, I don't want to explain something that everyone already knows, but a family office is when you are extremely wealthy, like billionaire status. You hire investment people to work on just your investments, and you hire tax people to just work on your taxes, and you hire If your family is into art, you'll hire an art advisor, for example, or someone to manage your aircraft. And so you have someone who have a team of people that manages your financial picture completely. And that team of people is called a family office. Okay. So I spent about a decade in the space. I still have a foot in that world. And working recently with a very wealthy family here in Dallas as their chief investment officer. Okay. So as a part of that role, I spent a lot of time educating the next generation. This is how you read income statement. This is how you read a balance sheet. This is how you ask good questions of your executive. This is how you invest, all of that, just training people. And honestly, I spent a lot of time being trained. Because I grew up lower middle class. I was taught the power of thrift. The way that the extremely wealthy think about money is entirely different than the rest of us, which could probably be its own podcast. But so I don't want to go down that rabbit hole unless you'd like to. But there is a cliche in the family office world that is, you go from shirt sleeves to shirt sleeves in 3 generations, right? So typically generation 1 makes substantial wealth. Generation 2 kind of preserves the wealth, and then by the end of generation 3, the wealth is gone. And why that is the topic that is discussed in family offices over and over again. And here's a secret: it's never because of bad investments, right? Because they hire professionals who do a good job managing their investments. It's never because of, and to say never is a stretch, sure, but it's almost never because of, bad legal advice. It's almost never because of a bad business decision, although sometimes. It is almost always because of other things, more soft things, right? More human things. It's because of family infighting. It's because of bad governance. It's because of, you pick a topic that really has nothing to do with, is Apple a good stock? That's not the reason. So there are these very human things that creep into the investment equation as we live our lives, that have more of a bearing really than on your portfolio allocation or exactly what investments you're investing in. And those are the things that I think, as you and me, like as advisors to individuals, that I think we can add a lot of value for, right? The portfolio problem, look, it's not easy. It's the math is complex. There's a lot of moving parts to it, but it's a solved problem, right? It's the human side of the equation that we get to add value to. Okay, so sitting down with someone and building rapport. For example, I have a client, and I've worked with him a long time, and we have a very good rapport. And we were kind of sitting around doing a portfolio review one time, but you know how those goes. I mean, you spend 10 minutes talking about the money, and you spend 45 minutes to an hour talking about the family, right? And we were just kind of talking, and it came out that they said, I'm just really worried about passing this money along. And I said, well, what are you worried about? And they said, well, our second son is kind of a spendthrift, and what can we do? And that, we went down the road of what the options are for when that's the case, which we can get into or not. But what I realized in that moment was that they only shared that because of the amount of time we had spent together, because of the trust we had built, right? They didn't even think there was a solution to this. They didn't even really think of it as a problem until we just happened to be talking about it one day. See, that's the value that an advisor brings to the table, right? Is Apple a good stock? It's let me come along for your life and kind of ride along with you, and let's talk about life. And then every now and then, there's going to be something that I can add value to, right? Like that you didn't even know existed. So, more than anything, I think it's those very soft human things that we should be doing best and focused on, right?
I love it. I love it. So the very touched upon a lot of things there. We talked a little bit right at the beginning about family office, and for people, for listeners who aren't aware of what that is, you kind of broke down the structure of that. It's ultra high net worth families that are able to kind of silo off and hire these different professionals for all the different aspects of their financial life. But then you talked about something that's really important. You talked about multi-generational wealth and the
Mm,
idea of being able to pass it down from generation to generation, and the idea that if it's not done properly, it won't happen.
that's right.
uh, it, you sometimes giving somebody a big bucket of money if they don't know how to handle it isn't you're not doing them a favor necessarily. So you talked about the soft skills, the communication, really, the family dynamic, and being able to address those that sometimes can be the most important things, even bigger than the dollar signs there. So really, really important stuff there. We've got just about 5 minutes before we hit the end of the show here. What's one piece of advice that you'd give to listeners aiming to apply the principles of goal-based portfolio theory to their own financial planning?
Mm, one piece of advice. That's a tough one. I think I would say two things. And this is what is, I think, going to change our industry at the core. The first thing is that it is customized. It is individualized. That if you're going to do goals-based investing properly, it is unique to you. Your portfolio looks unique, and the way you manage it might look unique. And the second thing that comes out of it is that whether we like it or not, individuals are market timers, right? It's kind of going back to what we said at the beginning. That there's a point at which you need your money, and if you're about to retire and 2008 hits, you have to change your goal, right? If you're riding it all the way to the bottom. So how do you manage those risks is very important. How do you manage downside risk? How do you manage upside risk, which is not something that's talked about a lot? Upside risk is the risk that markets move higher and you're not in, you're in cash. Long term, we know that cash is the worst investment possible because of inflation. Okay. Now it may have a role short term every now and then, and but see, balancing those two risks, upside versus downside, given your goals and what you're trying to do, is very important, and that is something that is not often talked about. So I think those two things. I cheated, and you asked me for one. I gave
Now,
you two.
too, we got a bonus one in there. That's awesome.
There you
That
go.
no, that is fantastic. The idea of managing risk. We talked about downside risk that we hear everybody talk about, but then also the upside risk, the opportunity loss, or not being in the market when it's going up, right? And how that differs for each and every individual depending on where they're at in their life and their time horizon. You started by talking about customization and where our industry is going or should be there. Individualized advice. So that's super important. I think that's a great place to leave it here. I have a whole bunch of other questions I wanted to ask you, but we're actually bouncing towards the end of the show here. What have I forgot to ask you that you'd like to leave listeners with today?
Oh goodness, I don't know. I'd be curious about you. What you've been in the business a while too. What's your being an outsider? I'm always kind of collecting advice, right? So what's something in your experience that you kind of have carried with you that's really different than maybe what you were taught, or what the standard line is in the business? Do you have something
Yeah,
that?
no, we that's one of the reasons you're on this show is I felt I felt an affinity there with your approach to the investment management piece because I'm an active manager and I use like total return or absolute return. And so the idea that modern portfolio theory, I don't necessarily say it's wrong. I'm just saying that the tools that we use to get there may not be the same tools that we use when it's time to start taking distributions, right? When we actually need
Yeah.
access to it. So I'm right there with you. I really like it. I'm gonna read your book. We got this one scheduled so quickly that
Yeah.
it was within a week. So I was like, okay, that's great. And you're there in Dallas, so I know we've got listeners here in the Texas area that look you up. What is the best place for listeners who want to find out more about you to get in touch with you?
Yeah, so you can find the website is directional-advisors.com, and it's ORS and advisors. I'm on Twitter, Franklin Parker one. I'm on LinkedIn at Franklin Parker. I'm not hard to find, but love to connect. Would love to keep the conversation going with anyone that it resonates with. So, thanks for having me here.
I love it. I love it. Franklin, thank you so much. We're right here at the half hour mark. Have a good rest of the day.
Thank you. Take care.